Okay. So equity versus debt, both types of fundraising. Talk about the sources of financing for both of them. Talk about the process itself for equity. I'll drill down on equity specifically, and then talk about the timeline, how we'll project this into the future, and then dive deeper into Tizeti's own specific case on how we raised $5.1 million. So equity, we all know what equity is. Get investors to give you funds for an ownership stake in your business. It's more long-term. It's the most expensive in terms of all types of financing because you guys are tied together till there's an exit. An exit may come from the business being acquired, or you become a public company via an IPO. So think of it like a marriage, and it's long-term, and it's very important you pick the right set of investors because you're going to be in bed with them for a very long time. Good thing the pro about it though is that because they have a stake in your business, they can be helpful when you need their resources, so you can piggyback on them because they have vested interest in the business, right? But the process for that, getting that equity financing, is very rigorous, and I'll try to simplify it and give everybody an understanding on how the process goes. Debt on the other side, I would say is relatively straightforward. You need X amount of money. You agree to pay, they charge you an interest, and you pay that amount. Usually we'll have a tenor, how long you're going to have to repay that amount that you borrowed, and other covenants you have with the debt. It's more hands-off, so it's on the equity side where investors are kind of involved in your business, depending on if they're directors or they're just stockholders, shareholders, as the case may be. With debt, if you're getting a loan, it's more hands-off. They just want to get maybe some reports, maybe quarterly or annually, just to show that you're doing okay, and then the evidence that you're doing okay is that how you're repaying the debt itself. I would say it's risky because debt always sits above equity in terms of if anything goes wrong. So you have to pay back the people you owe before you even think about the shareholders themselves, right? And in the event of default, if it's a loan that is structured as some kind of asset as collateral, you might lose that if you don't pay back. But if you also are structured it such that it's a company's equity that you're using as collateral, you might lose the company in that scenario. There's been various cases, if you think about it, T-Salat, right, and how they ended up being Nine Mobile, and even other cases outside of Nigeria where the founders of the company have put personal guarantees for those loans. So even when the company goes bad, they can still claw back on some of your assets. So that's why I said it's kind of risky. So they both have their pros and cons. In terms of sources of financing for both of them, for equity, you usually start off with your immediate network, which is your friends and family. Everybody more or less starts from this, depending on the kind of network you have. And then you can progress to angel investors, which are high net worth individuals that typically invest in different companies. That will be the next level in terms of equity. Then once you're past that level, you can then attract either venture capital, if your business is one that it can be funded via venture capital. So it's a business that has a huge upside and can be a really big business. Or you could go the private equity route, which is they usually own the majority of the company and they hire a management team. So you may not even be the one managing it, but you may still have your stake. And then finally, everybody's kind of goal is if you can grow the business really huge, and then it becomes a public company where anybody can be your investor. So you have a wide pool of anybody pretty much can buy stock. Sorry, is there a question? Okay. On the debt side usually starts small too. So the equivalent for friends and family, I would say, is the convertible notes where someone is borrowing you money, but they, instead of paying back, or even if you're going to pay back, they have the option to convert that debt into equity in the company, right? So usually small amounts that maybe a friend of yours wants to give you money, but he's not too sure about the business you're doing. So he wants to be able to earn some interest while you're trying to seek other investors. So he'll go with the convertible notes. Then the form of debt that everybody understands very clearly is the bank. But banks usually won't give you anything except you have collateral, which is funny because you need the money to be able to get the assets for the business and to run the business and generate revenue to pay back the bank. but the bank requires collateral and assets. So which one comes before the other? Which is why not a lot of people go with the bank route, except you have assets that you can put down. But funny enough, banks don't actually, in Nigeria, in the context of Nigeria, they don't give loans, and even when they give, the interest rate is huge, right? On the colour side, if it's outside of Nigeria, there are firms that specialize in venture debt, which is almost the same thing like a convertible, same thing like almost like an equity round, but it's tied to you paying interest on the amount they give you, and then it can also convert to equity as the case may be, right? But in those scenarios, they don't ask for any other collateral other than basically the revenue that the business is generating that is secured on the revenue of the business, right? And the same kind of firms, private equity firms and venture capital can also structure debt for you. So you could have a financing round where part of it is equity and part of it is debt too. And then the equivalent for an IPO for me on the debt side would be like a bond or a commercial paper. Commercial paper is like a bond, but for a shorter tenure, where you basically go out to the public, talk to institutional investors, and they can invest in your bond, and your bond is tradable, maybe listed in Nigeria, I think is FMDQ, right? So that's it's also from, but again, you're paying what we call a coupon, which is still interest, the fancy name for interest. Okay. Now, for the equity fundraise process itself, I would say it starts with where your business is domiciled, right? If your business is in Nigeria, you have to fundraise in Nigeria. But what has technically happened with most of the tech companies, oil and gas interest, is we've seen that it's difficult attracting investment from Nigeria because you're limiting the pool of people that can invest in your business. You usually will reincorporate your company in some other foreign domain. If it's in Africa, you still want to be tied to Africa, it will be Mauritius. In the US, if it's in the US, it will be, you try to get a Delaware, reincorporate as a Delaware company. We did that for Tizeti in December 2016. But that way, all of a sudden, you now have this pool of net investors that can now invest in your company outside of Nigeria. But before you get to that, your first round is your friends and family round using convertible notes. And the documentation you need is more or less like an executive summary. You're just writing down your thoughts on what you think this business is, what you think the potential is, and then you share it around with an email as an attachment, send it to your friends. And those of them that think that you have some entrepreneurial skills will come in. It's also the most riskiest round because if the business is not proven, then so at that point, they could pretty much lose their money if the business doesn't succeed. But it's also the best because if you come in really early, the business is really small, so you can have a sizable chunk versus paying for a larger amount down the road, right? And it also helps your friends and family put in it because they are the ones that can actually give you feedback immediately of your business. Those kind of questions that you're going to answer down the road for investors, you already start answering them from your friends, right? And then next thing you should do is execute on the business plan. So you've written your executive summary, you say you want to do this. Next thing should actually be get some traction on the business. I know some people focus on, oh, I need money to get the business, but you can actually bootstrap the business with just a little capital that you invest for your friend. Try to grow the business a little bit. And in that interim period, when you feel that you're starting to get close to where it makes a lot of sense and you seriously need more capital before you run out of capital. So always try to fundraise before you run out of money. You should prepare an investor deck or presentation. What basically is description of the business, the financial projections for the next couple of years, and what you want to use the funds itself for. It also includes things like your team that you have already, or team that you potentially want to hire, and some kind of roadmap of where you see the business over the next couple of years. Then once you've made that deck, you should make a list of dream investors that you would love to invest. So you say, oh, who do I want to invest? Maybe they have some kind of network that you want to leverage for and some other reason, right? So you've made that list. But next step is wake up and stop dreaming. It's not going to happen. So your business is very early stage. I know I said that, but really, they probably won't invest. And what you should really be doing is building relationship with some of them, the ones that you can. So if it's conferences, if it's people that know them, you start getting to know them and then start sending them updates on how the business is. Because normally, if your business is too early stage, nobody's really going to invest at that stage. So I had one VC I was always emailing, and then they'll give you feedback. You can go to them for advice. You are building relationship so that in the future, when you actually get to the size at which they can invest, or you develop enough traction, then you can. It's not as if they're just hearing about you for the first time. They've seen how you've been progressing, how fast your business is growing, right? So in the interim, you have your presentation ready to go. You should grow your business till you hit a major milestone. It could be a revenue milestone, it could be a product milestone, right? Then get pressed to feature that milestone. So yeah, now your business has progressed a little bit, and then you can get pressed. The reason being is you've been building this relationship with investors. They've been seeing how your progress is. All of a sudden, they just wake up one day and you are the one being featured in some kind of news. That usually is the trigger for them to say, okay, since these guys are going somewhere, let me take it now. Better look at them, a closer look at them, right? So at that point, you already have your deck. You just update it with the latest information. You create a data room. The data room is all the information about your company that any investor can just look at and see how you're doing. And I'll go into details on it in the next slide. And then you start practicing your pitch, what you're going to say. You don't want, investors don't have a lot of time. They talk to a lot of people. You want to be able to refine your pitch so that you can nail it on the when you're talking about your business. You're very good at doing it. Then what now happens is from that list you already have, you can then start pitching to those set of investors. Some may say yes, some may say no. But in every step of the way, you should always ask for feedback, right? And I would say when you look at that, your list, start with the least important so that you get better at pitching them, so that you get better at answering the questions that they ask, because they usually typically answer on the same type of questions. But as if you've answered it when it doesn't matter as much, like when I say least important, right? You now get better, and then you as you're talking around, you get more confidence as you go through the process, right? And every step of the way, even if someone doesn't say yes or no, you should always ask them, is there anybody you think I should be talking to that might be interested? They may even do introductions. Now, there's a catch-22 with that. If someone didn't invest, it's likely when he refers you to another person, that person might not invest. But it's part of also just growing your network and then having this additional list of investors that you keep updating so that in the future, because someone said no today doesn't mean they can't say yes down the road. Okay, I've had investors that very early, but later on they invested in us. So then if investors are serious, there's a lead investor, he will now conduct what is an initial due diligence. So all that information you were saying, right, that you put in your data room, right, the investor now wants to check it to be sure that you're not lying, right, more or less as far as best as they can. Then they will now give you a term sheet, right, which says the terms on which they're investing. Okay, I'm going to give you X amount for 20% of your business, and I'm going to get a board seat, and I'm going to just outline some of the high-level terms that they want to come in. That also protects them, how frequently you should send them updates and all of that. You usually will negotiate the terms in the term sheet, get a good lawyer, because this is now, remember when I said this is a marriage, so you should ensure that most of the things protects you, protects their own interest too. And then once you have signed off the term sheet, you do conduct final due diligence. So this is really checking everything, nuts and bolts, who are the existing investors. And my point before on Nigeria, if you've raised in Nigeria, make sure you're not taking money, you're not taking any investment from any political exposed person, because that way no new investors will check, because they're going to check every single shareholder you already have before they even put additional money. So if you in the friends and family round, make sure the high network individuals that you're taking money from are clean in quotes. Then you close the rounds and hey, everyone's happy, you announce it as the case may be. The reason being announcing is you want people to, first of all, they've heard about you when you hit that milestone. Next is about the fundraise. What that does for you is it creates more visibility and even creates more investors that will be interested in you when you get to your next fundraise, right? And then you continue executing, maintain investor relation, maintain good relationship with investors. Some may be difficult, as the case may be, you manage them. I think of it the same way you manage a boss if you're working in an organization. You have your board meetings from time to time, and then you execute to meet your projections. So those projections that you already put in as part of the index, they're going to hold you to it. So you want to be sure that you get the money, that you're also hitting those milestones. And then you go through this whole process again every time you raise the financing. So what's usually in the data room? It will be your corporate structure. For example, if you're a little larger, we're in 2 countries, it would be all the subsidiaries and all the information about them, the certificate of incorporation, list of shareholders. Then you also have a financial section where all your financial statements are there. Please get an auditor from year one. Pay your taxes too. You're going to ask for all of those kind of things, and then the projections you made on how the business is going to over the next 3 to 5 years. Right. Then they'll also do the business side of things, which is the kind of markets where you whatever service you're providing or product you're selling, right? How you're going to acquire customers when they give you this money, how you're going to use the funds, and then competitor analysis, which gives the investors understand that you understand the market you are, who your competition is, right? And then your KPI. So what have you achieved to date? So fine, projections is money, but there may be other things. How many customers you have. Right. So sorry, can we all mute our phone so that okay. And then there's also a section about your technology, whatever service you're selling, and your team. Very important, because we all know that it's your team that actually drives those results. So they ask for your team bios and resume of all your. Okay, can we hear me? Yes. Okay, cool. 1 second. So in terms of fundraise timeline, so I drew the timeline from start, friends and family, which I said 0 revenue. You're just starting off all the way to an IPO, right? So we start off with friends and family. Then you do what I'll call a pre-seed round, where your friends, you're still less than $500,000 in revenue. You're still building the product, not necessarily that much revenue at that point in time. Then you now do a full seed round where you can actually get real investors. So it may be angel investors, it may be a firm too that might be interested in you. At that point, you are doing revenue of about $500,000 to 1.5. Now these numbers vary. I'm just trying to put in the average range. Right there, you have a functioning product or service, and you're generating some kind of revenue. The next, which is the most important one, is if you really have a product and you're going places, you will now be ready for what we call a Series A, where you're typically a Series A company where you're going between 1 to 7 million in revenue. You've achieved product market fit. The business is basically selling itself. You just need more resources to market, right? And you have a strategy, so you need money to actually grow the business. Right. So everything you've done up to Series A is you're playing, not playing, but you're building the business, right? But from that Series A point, it's now a serious business. Then Series B is the growth stage. So most companies that you can think of, most startups are in Series B stage where they're doing 7 to 10 million in revenue. They've hired an experienced team. They have a management team in place. Even the founders may not be doing as much, depending on how you rate CEOs, right? And then Series C is then the business is really big. It's 10 to 100 million. You're developing more products. You're expanding into new markets, right? So the business is growing really big. And then Series D is what you just do slightly before an IPO. Some people have EF, but D is the average where you're now a huge business. You just want one last round to get to the finish line, and you're doing about 100 million in revenue. You're getting everything in, because now you're not going to be a public company. The SEC is on you and all of that. And then you IPO, which is you sell your shares to everyone, retail investors. And then, but in every stage, even at the IPO, you're actually raising money from those investors. So there's always money you're raising at every point in time as you grow the business and grow the business very large, very large. Okay, Tizeti. So for Tizeti itself, we're an unlimited internet service provider. I got the idea doing my master's in Canada, where it was the first time I was using it in my school. We're one of the first schools that had campus-wide Wi-Fi around the entire school. So I wrote, I just had my blog, then I wrote a post about what I see myself doing after my master's, but I didn't do anything. I just had the idea, but didn't do anything about it. So I came back to Nigeria in 2009 with Exxon. I got hired by Exxon in Canada and moved back to Nigeria, right? And working with Exxon within the first year, I had a mortgage in Nigeria and in Canada, and I decided, man, I think I need to make some extra money to be able to balance everything. So I had this idea of a movie streaming box, which is like any of the streaming boxes that our smart TVs do that for us now with Netflix and all of that. But I thought about selling that box to people, right, with movies on it. But when I looked around, I didn't own the movies, right? So I had to make deals with the content owners in Hollywood and Iroko TV, right, in Nigeria. And then I needed internet for the box too. So anybody that was going to buy the box to use it to watch movies needed to have internet too. And internet is expensive in Nigeria. So and I was banking on Swift then had unlimited plan. But Swift now canceled the unlimited internet plan. So I was like, okay, this box is kind of useless. I don't want anything apart from the box. Um, so I saw an opening in the market, and I then, given that I'm doing my master, I thought about how to deliver internet, and I decided to go for it. And I started first with the estate I lived in, Friends Colonial Estate. Went to got referred to another estate close by, which was Carlton Gate Estate. Carlton Gate Estate, the chairman, his brother too, was an esco in an estate in phase one called Treasure Garden. And then from there, we just kept on going all the way to Crown. But by the time a few years, we had covered most of the major estates in Lekki. And then someone convinced me that, hey, you can make this into a business, like instead of just doing it part time and all that. And then we went into Lagos mainland, and we just kept on going like that. We've gone to another state, different states. We're now even in another country, Ghana. So we just kept on going and growing and growing, and we're now a multi-billion revenue company. Just started off from my boys' quarters in France Colony, right? So my own fundraise journey, right? So same thing. I followed the same steps I'm giving you. I sent my friends and family email to my closest friends. I couldn't. The funny thing is, I couldn't even leverage my network in Moto because I didn't want anybody to know that I was doing this, right? So when I sent it to all my immediate friends, as always, friends were like, "What kind of business are you trying to do?" Where there's MTN, Airtel. I got only one response from, funny enough, my co-founder, Ifeanyi, right? I didn't take the money then. I was just like, you know what, we'll just keep going. So we bootstrapped. So from the revenue from the business itself, we just kept growing, building new towers and then growing and growing. And then we got validation after a few years. NCC had this hackathon where they wanted businesses to come and demo what they were doing. And we came second runner up. We got 500K. That was a huge boost then for the team itself. They were like, guys, we're onto something, we're doing something really good. But we kept on going like that, and we did something that then nobody had done. We were able to get to 1 million in revenue without any investors. So you see why I stress execute on your business. It's not because people always think that fundraising is what is success. Success is actually getting customers and the revenue from them and making profit from them. Right. After that, around the time we're getting to 1 million, we also now got accepted into Y Combinator, which is an accelerator in Silicon Valley. And that's what made us reincorporate the company in the US. And then off of that, we had a demo day where we pitched to investors in Silicon Valley and some investors all over the world, come for that event. And we were then able to raise 2 million at that time, which was one of the largest seed rounds in Nigeria at the time, for a Nigerian company at the time. And then on the back of that, we tripled revenue. Then we also raised our Series A. So between both rounds, we've raised about $5.1 million. And I just wanted to show it. This was the email I sent to most of my friends. A friend of mine sent it to them on my behalf and said, hey, I'm sure that Kendall has reached out to you about a startup focusing on high-speed Wi-Fi, particularly in Lagos. Initially, I sent my deck, which is something I told you to do to have your presentation ready to go. And then I try to give them very good terms. If anybody had bought this, invested in this, they will own significant amount of Tizeti. And hey, we kept going and got early press. So this was on international Muni Wireless, which was one of the bigger Wi-Fi wireless blogs at the time in 2014. She covered our launch in Lekki when we now left the States and we're now in Lekki phase one. And then Tech Lawyer, which was one of the biggest then tech publication in Nigeria, also covered us. And from this was when everybody now started saying, oh wow, who's doing this business? But nobody knew who was behind the company because I was still moonlighting in next Sunday. And then this was when we won the hackathon. You can see my team really happy, showing that yes, we're going places. Won 500K. We've turned that 500K into raising $5 million by just steadily just working really hard and growing the business over time. And this was when I got to Y Combinator. This was my demo day when I picked up my business in front of all the who's who in Silicon Valley, like all the top investors there, and they all and we raised 2 million from that, and then the rest, as you say, is history. Okay. Thank you, everyone.
Thanks very much, Kendall. Really appreciate your time to talk us through. So I guess I'll leave it open to the guys if